What is property, plant, and equipment in terms of its elements? Good. Long term or short term? Good. Non-current, eh? Okay, so property, plant, and equipment is considered a non-current asset. Do companies need property, plant, and equipment to operate? Yes, they do. Why do they? It's because of this, operational capacity. Businesses need assets in order to operate. Okay, the more assets we have, the more we can do. Where are we going to see these accounts being recorded? You're going to see this in the financial statements. And you're going to learn about this, notes. A note to the financial statements. That's something that is going to be provided for in terms of your property, plant, and equipment, your PPE. Okay, the note is just additional workings. Right, the key is more the depreciation and the accumulated depreciation and the workings around it. Right, but disclosure is a focus, and it can be a focus in tests and exams. Okay, so you do need to consider it as well, okay, just in case. Right, disclosure is very important. Do stakeholders and shareholders want to see the detail? Of course they do. Right, so what is a non-current asset? Well, it's tangible, it could be intangible, and it can be financial as well. The ones that we're going to be looking at are going to be the tangible assets, because these are assets that we can use, and these are assets that will be depreciated. Right, what is depreciation? Well, it's the writing off of use over the asset's life. Okay, so remember, let's talk about a vehicle. Does the vehicle lose value? Yes. If the vehicle is used for many years, will it have more or less value? It'll have less value. So depreciation is the writing off of the asset's value over its life. Okay, so if the asset has a useful life of 5 years, I'm going to write off the asset's use over 5 years. Okay, we need to know what the cost price is. Is the cost price going to change? Cost price? No. It won't change. If you buy something, that's the cost price. You can't change it once you've bought it. Okay, obviously, if you've bought something, that is the cost price. You can't go back in time and change how much you bought it for. Okay, so when looking at property, plant, and equipment, the cost price stays the same, and it's very similar to inventory. That's why I've got these two together, because historical cost is the same. Right, what am I going to do? I'm going to include all expenses that relate to installation and setup. Anything. So I can't use a machine if the machine hasn't been installed. I can't use a vehicle if the vehicle hasn't been delivered. I can't use equipment if I don't have it. Okay, so setup costs, installation costs, delivery costs to get the machinery, okay, the transport of the actual asset would be part of the cost price. Okay, what must companies do? They need to keep track of all their assets. So companies use an asset register to monitor how many assets they've got. Okay, because we said earlier, companies need assets because it's capacity. Right, the more chairs and tables you have in the business, the more you can do. The more laptops and computers you have, the more you can do. The more vehicles you have, the more you can do. Okay, so businesses need to keep track of these assets because they're valuable. Remember from your previous basics, assets generally create income. Okay, expenses generally arise from liabilities. Okay. Right, so this is some recap. Recording the purchase of inventory. Inventory, what am I saying? Property, plant, and equipment. Okay, if I'm recording property, plant, and equipment, I'm going to have to debit it, right? Why? Good. And why am I debiting it? It's not just an asset. It's an asset that's increasing. That's why I debit it. Do you agree? Okay, so always remember the reason why you're doing something. Okay, not just because I studied it. Okay. Right, so property, plant, and equipment is going to be debited because, number one, it's an asset. Number two, it's increasing. I've got more of it. Okay, bit of revision. If I'm crediting bank, I'm reducing the asset because I'm paying for the property, plant, and equipment. So I can buy assets using cash, or I can buy assets using liabilities. If I buy and I use a liability, I'm going to credit the creditors because I'm going to owe someone. Does that make sense? Okay, new account, depreciation. What is depreciation? It's an expense. Why is it an expense? Well, I know what the definitions are. Depreciation can't be an asset, it's not a resource. Depreciation can't be a liability, it's not an obligation. Depreciation can't be an increase in benefit, there's no increase in benefit. Depreciation is an expense because it's an outflow or decrease in benefit. See, that's why you need to know your definitions. Okay, it's not capital, the owner's not involved here, there's no giving, and it's not drawings, there's no taking. Right, so the only definition that this can meet is expense. Depreciation is an expense. Why? Because it's a decrease in value. You're losing value. Accumulated depreciation, this is new. Accumulated means how much depreciation I have over the asset's useful life. Right, so the older the asset, the more accumulated depreciation it'll have. Do you agree? Right, so this is a negative asset. And the reason why it's a negative asset, it's because it's affecting the asset's value. Right, think about it. If I've got a vehicle that costs me, let's say 10, okay, and I've got 1 year's worth of depreciation, let's say it's 1. What is the asset's value? 9. Okay, so when looking at value, you have something called the carrying or the book value. That's the difference between accumulated depreciation and the cost. Okay, sorry, there's a typo here. What is the difference between? What is the difference between the asset's cost and accumulated depreciation? The spacing now. Okay, there's it. It goes to the next line. Okay. Right, so if I've got carrying value is calculated using this equation. Cost minus accumulated depreciation. That's how you calculate carrying value. Happy with that? Perfect. Right, now we need to know how to calculate depreciation. We've got two methods. We've got straight line and we've got diminishing balance. These are the two methods that you're going to be using in order to calculate depreciation. If I'm looking at the straight line method, I'm going to be using the cost price of the assets. Does the cost change? No. So the depreciation is going to be regular. It doesn't change. It's going to be constant. It's going to be the same year after year after year. Okay, you'll see what this looks like when we do some examples. Okay. Diminishing balance. What does that use? It uses the carrying value. Is the carrying value going to change? Yes, because what is carrying value? Cost minus accumulated depreciation. We know the older the asset gets, the less that it's going to be worth. Okay, so carrying value does change. That's why you've got an irregular or diminishing amount of depreciation. Okay, that's where the name comes from. Sometimes they call it reducing method, reducing balance method. Okay, diminishing, reducing balance method, either or, it just means the depreciation gets smaller. Is that okay? Right, here's the first example. Example A, an asset was bought for 500,000. The expected useful life is 5 years. Calculate the yearly depreciation, accumulated depreciation, and carrying value using the straight line method. Here, I am going to create a separate working here. Just go back to your workings. because I want to show you how to do this. Alright, so you need columns. You need the year, you need the cost, you need the depreciation, you need the accumulated depreciation, and you need the carrying value. Right, so if you're looking at any depreciation question, you're going to want to know what those amounts are. Okay, so example number 1. The asset was bought for 500. What does that represent? The cost of the asset. Is that going to change? No. Okay, it's going to be 500,000 forever and ever and ever and ever. Okay. How many years am I going to be depreciating this for? 5 years. So I'm going to have year 1, year 2, year 3, year 4, and year 5. Okay. How much is the depreciation? Well, it's 100,000 per annum. Okay, I want to show you something as well. 5 years is the same as 20% per annum. Right, sometimes they'll give you 20%, sometimes they'll give you 5 years. It's the same thing. You're either dividing by 5 or you're timesing by 20%. It's the same thing. Doesn't matter. Okay, so whether you've been given percentages or years makes no difference. Okay, so what is the depreciation for the first year? How do I calculate it? It's cost times 20% or divide by 5. Okay, so depreciation using straight line, cost times the rate. That's what you've got. Okay. For year 1, will I have accumulated depreciation? Yes, after I've depreciated it. Okay, so how much depreciation will I have after year 1? 100,000. What would the carrying value be after year 1? Well, what is carrying value? Cost minus accumulated depreciation. Good. Okay, so if you're going to be taking the cost, which is what? 500,000, and I'm going to minus it by the accumulator, gives me the carrying value. Okay, what will the depreciation be for the next year? Same thing, same thing, same thing, same thing. That doesn't change. Every year, using straight line, depreciation will always be the same because the cost doesn't change. Right, will the accumulator change? Yes. How much will I have after 2 years? Last year I had 100. This year I have another 100. Now I've got 200. So what's the carrying value at the end of year 2? 300,000. Yes, the 500 minus the 200. Okay, how much accumulated will I have after 3 years? Well, last year I had 200. This year I've got 100. So now I've got 3. Carrying value of the asset is now 200. How much accumulated depreciation will I have after 4 years? Well, last year I had 300. This year I've got an extra 100, 400,000. Carrying value at the end of that year, 100,000. After 5 years, how much accumulated depreciation will I have? 400,000 plus 100,000. Carrying value at the end of year 5, 0. Okay, and this is what you would do if you're looking at all of the different years. Makes sense? Okay, so that's the first example. Example B, I want you to work it out. What's the yearly depreciation? Straight line method for an asset that was bought for 960. Okay, what are you going to do? You're going to draw up a table. Okay, so same table. How many years though? 25% is how many years? 4 years. How did I get that? 100% is the full value of the asset. Same thing here. 5 years. 100 divided by 5 is 20. 20% per annum. Here, 25% is the same as 4 years. Okay, because it must make up 100%. Make sense? Okay, so year 1, year 2, year 3, year 4. I want 4 years. Quickly draw that up. Great. So you've completed that. Now let's check your answers. Okay, obviously 960 is the cost. Does the cost change? No, it doesn't. Depreciation, they said, was over 4 years, so you can divide by 4, you can times by 25%. That's not going to change. Cumulated depreciation is going to be adding all of that added up. Did you have all that? Perfect, well done. Right, so that's looking at straight line depreciation. Okay, let's now look at diminishing balance. Here you've got diminishing balance, and we know it's calculated on carrying value. Carrying value is going to change. Do you agree? Am I going to change the way I do things? No. Same table, different method. Okay, so let's take our table down. Let's write diminishing balance. Okay, and you'll see question or example C. Example C is the same as example A. The only thing different is what? The method. Same years, same cost. Alright, so the reason why I've done that is to contrast it. So this is straight line. Okay, this is diminishing balance. Okay, so now how do you do diminishing balance? Well, let's discuss it. You're not going to have the same amounts of depreciation because they're all going to be different. Okay, remember, diminishing balance uses carrying value to calculate depreciation. Okay, cost will stay the same. It will never ever change. Okay, because you can't undo the past. If you buy something for 500,000, you're going to buy something for 500,000. Okay, depreciation, well, it was 5 years, right? So I can take this, I can either times by 20%, or you can divide it by 5. You can decide what you want to do. Okay, I'm going to divide by 5. I'm going to get that. Okay, if you times by 20%, you're going to get the same figure. Right, what will the accumulated be? Same amount. What will the carrying value be? 400,000. Okay, so the first line of your diminishing balance will be the same as your first line for your straight line. Have a look. See, those two lines are the same. But the next line, it's going to change. Okay, so what do I calculate depreciation on? We just spoke about it. Carrying value. So when I look at depreciation for year 2, I'm going to use carrying value at the end of year 1. Right, so depreciation is going to be this times 20% or divide by 5. That gives you 80,000. Okay, how much accumulated do I have after 2 years? Last year I had 100. This year I've got 80. I'm going to end the year with 180. Makes sense? How do I work out the carrying value at the end of year 2? Cost, which is 5, minus accumulated, which is 18, gives me that. 320. Happy? Okay. Depreciation for year 3 is going to be calculated on carrying value from year 2. So this amount times 20% or divide by 5 gives you 64,000. Is that okay? Keeping up? Alright, what's the accumulated depreciation going to be? What I had last year plus what I've got this year, 244. Last year's 180 plus this year's 64. Got that? Great. Next line, carrying value. Cost minus accumulated, always. It's always cost minus accumulated, cost minus accumulated, cost minus accumulated. Okay, it gives me 256. Right, let's do number 4. I'm going to take 256, I'm going to divide it by 5 or times it by 20%, either or, gives you that figure. Last year plus this year gives me 295,200. Okay. Carrying value, cost minus accumulated. Right, and then the final line, depreciation is going to be that. Okay, it gives you 163,840. All right, and that's what you would do to draw up all of the different lines for diminishing balance. So diminishing balance is actually more tricky because you have to go line by line by line, or you're going to need totals. Okay, so total accumulated, and so on. Okay, and that's why they tend to test the diminishing balance a bit more because it requires a little bit more workings. Right, but it's not difficult. You're just using what? Your carrying value. That's the key. Know what you need in order to do the calculation. Makes sense? Perfect. Okay, I'm going to give you guys one for homework. Right, there's the answer to that one, obviously. We've got a better layout. See, this is how I want you to do it. Okay, those are the answers that you would get. Okay, example D is for you guys to do as homework. Okay, next week we'll discuss it. Okay, I'm going to show it. Actually, I'm going. Okay, well, let me not. Okay, I'll put it here just now, but then next week we'll discuss it. Okay, I want you guys to work it out ahead of time. Okay, as practice. Right, to see how example D goes, that's homework. Carrying value, diminishing balance. It's the same asset as we saw earlier for B. Okay, except this is D. And we're using diminishing balance, not straight line. Okay. Right, the last one is just other things to consider. Sometimes you could be given other methods for depreciating an asset. Okay. This method is looking at the number of units produced. Okay, this is not important, it's just additional. Okay, depreciation, remember, is how I use the asset. Okay, so if I'm using the asset, I'm going to depreciate it. So as and when I manufacture units, I'm going to have depreciation. That's what this is looking at. Okay, so for example, if I manufacture 1,000 units in year 1, then the depreciation will be 1,000 over 500. Okay, instead of a percentage of. Right, that's all. Okay, so it's not that important. Doesn't really get tested. Okay, this I did see in your assignment. Okay, I was looking at assignment 2 while you were busy doing that table. And I see in assignment 2 they do test you on the note. Okay, so we need to understand this note. Right, so let's show what happened. I'm just going to show 1 year from our table here. Okay, I'm going to show this year. Is that too dark? Yeah, might be. Okay, let's use that. Okay. Right, so if I'm looking at year 3, I'm going to want to record everything for year 3. Okay, from our example. Okay, here's our example. Okay, so if I'm looking at year 3, what was my starting carrying value? What was the carrying value at the beginning of year 3? 320. Good. Okay, because end of year 2 is beginning of year 3. Right, so 320 is going to go here. Insert it. Okay, the 320 is made up of what? The 500,000 cost and the 180 accumulated depreciation. Remember in accounting, accountants show things that are negative in brackets. Okay, that's disclosure. See, I'm showing it. Let me type it in rather, it'll look neater. Okay, so 320,000 comprises of 500,000 minus 180,000. Okay, transactions for the year. I didn't have any additions. I didn't buy anything more. I didn't have any disposals. I didn't sell anything. But I did have other depreciation. What was the depreciation for year 3? No, depreciation for year 3. 64. Do you agree? So 64,000 is going to be my depreciation for year 3. Does that make sense? Okay. Right, and then at the end of year 3, what do I have? Carrying value. And my carrying value comprises of 256, which is the cost, which doesn't change, 500,000, and accumulated depreciation here, which is now the sum of what I started with what I ended with, which is 240,000. Okay, that's something to consider. Okay. Makes sense? Perfect. Okay, so just remember that when looking at disclosure, accountants want to disclose more information. And if they disclose more information, they require you to show the detail. Right, this would be detail. Showing the beginning, showing the end, and showing what happens during the year. Okay. Alright, if an asset is purchased during the financial year, how do we calculate depreciation? Well, let's think about this. If I haven't used the asset for the full year, can I depreciate it for the full year? No, you can't. Depreciation, we said, is the use of the asset. So if I use something, I depreciate it. Okay, I can't depreciate assets if I haven't used it during the year. Does that make sense? Okay, so if I'm looking at an asset, I'm going to be depreciating it for the months that I've used it. Right, so in this example, a new asset worth 800,000 is purchased 4 months before the end of the financial year. Depreciation is provided for at 25% per annum using the straight line method. Calculate the depreciation for the first year. Have I used the asset for the first year? I've only used it for 4 months. Right, so I'm going to have to pro-rata the depreciation. Pro-rata means part of the year. Okay, so I'm going to pro-rata this for 4/12. Okay, I'm using straight lines. So what is my cost? 800,000 times. What is my percentage? 25%. Then I'm going to multiply that by 4/12. Okay, that's pro-rata. You can do it in 2 steps if you want to. Okay, it's 800,000 times 25% times 4/12 gives you this. What is that representing? It's representing the depreciation for the 4 months. Is that good? Great. Question. What is the carrying value at the end of year 1? That you should be able to work out. Okay, let me ask you this. How do I calculate carrying value? So what's the cost? What's the cumulative depreciation? After 1 year. After 1 year. Well, at the end of year 1. At the end of year 1, how much depreciation does the asset have? Not for the full 12 months. Yes, because you've only used it for 4 months. 66,666. Okay, yeah, so the comma is just for the thousands. Right, so that's the carrying value at the end of year 1. Okay, so you're not looking at the whole year because I haven't used the asset for the whole year. Because think about it. This asset was bought and it was only used for 4 months. So the carrying value is only going to be for 4 months. Does that make sense? Perfect. Happy with that? Great. Right, and then the last bit is just a note about asset disposal. This can come up. If it does, it's something that we'll look at in the past papers because it's a T account. Okay, I'll either cover it in your assignment if it comes up there. If not, I'll cover it in your past papers. Okay, it's not a very difficult thing to do. It's just looking at this. Selling or writing off or trading in assets. Okay, so what am I going to use to do that? I'm going to use a asset realization account. It's a T account. Okay, and the T account is called the asset realization account. Okay, is this account an asset, liability, income, expense, capital drawings? It doesn't have a element. Why? It's just a working. So asset disposal is just a working. Something that you need to do in order to get an amount. Okay, so how do you do an asset disposal? Here's the first bit. Number one, process the depreciation until the day that you sell it. Okay, so if I'm selling the asset halfway during the year, I need to process depreciation until the day that I sell it, because I need to know what the carrying value is. Okay, get the carrying value. That's why you're doing that. Okay. Number two is to transfer the accumulated depreciation to the realization account. Okay, meaning I'm removing the asset. So if I'm removing the asset, I'm going to get rid of the depreciation. If I'm removing the asset or disposing of the asset, I'm going to move out the cost. Okay, I'm going to remove the cost. Okay, so that's what you're looking at here. Okay, so that's step number 2 and step number 3. Get rid of the cost, get rid of the accumulated depreciation. Okay. Number 4 is record any proceeds, any amount that you've received from selling the asset. Okay, so if I sell an asset, I'm going to have proceeds that are going to come in. And the last bit is to determine the profit or loss. Okay, so that's the slides. What I do want to do is quickly just show you what that would look like here. Okay, in terms of a T account. Okay, asset realization will have a debit and a credit. Right, so if I'm looking at asset realization, step number 1, process any depreciation on the asset until the day that it's sold. Okay, so that would have been depreciation until the date sold. Okay, what would that look like? It would be debit depreciation, credit the accumulated depreciation. Okay, that's step number 1. Step number 2, process the accumulated depreciation to the asset realization account. Okay, so what balance does accumulated depreciation have? It's a negative asset, so it has a credit balance. If it has a credit balance, it'll still have a credit balance here. Okay, it's simple. Right, so accumulated depreciation will go here on that side of the account, okay, because it's a negative asset. And then the cost, which is the next step, would go here. Okay, you're selling the asset. So this would have been maybe vehicles, right? This is the cost. Okay, because if I'm selling the asset, I'm going to get rid of the asset. Okay, you're disposing of it, your asset realization, asset disposal. Okay, so that'll be the vehicle's cost. Okay, then the next step was look at proceeds. If I sell the vehicle, okay, step 4, was this 4, I think? Record, yeah, I've got the right numbers. Okay, so obviously that was so 1, then 2, 3, 4, this is 4. Okay, so if I record the proceeds, you're going to debit the bank, and you're going to credit the asset realization account. Okay, why? Because you're selling the asset. So if you're selling the asset, do you get cash? Of course you do. Okay, so the asset is going to increase. You're going to get more cash than you started with. Right, so if I'm debiting bank, I'm going to credit the asset realization. Right, and then you'll have either a profit or a loss. Okay, so profit on sale of an asset is going to go on this side. Okay, the loss on sale of an asset will go on that side, depending on what happened. Okay, so if I have a profit on sale, when does the profit on sale occur? It occurs when my carrying value is lower than the proceeds. Okay, i.e., let me do this at the bottom here. Profit when proceeds greater than carrying value. Okay, you've sold something for more than what it's worth. Does it make sense? Okay, that gives you the profits. Loss when proceeds are less than carrying value. That's when you have a loss. Alright, so that's just the theory. Okay, we'll look at that if it does get tested. Okay, I haven't seen too many of those examples in terms of an asset disposal. Okay, it's a possibility, but we never know. Okay, so as long as we've covered it, that's okay. Okay, we'll look at past papers as a guide to see how important it is. Okay, but this is something that you might have to look at in terms of the actual disposal of an asset. Okay, all right, so if you can, remember to go through those study guide exercises. Okay, there's a lot of exercises there that you can use as practice to see if you're okay with depreciation. You've got one example here that I want you to do for next week. All right, so see if you can work out the table for diminishing balance for that one example.